Hi, welcome to day 74 of our 365-day live challenge. Today we are diving deep into the world of equity mutual funds and wealth creation tailored just for our Indian investors. Whether you are watching live or recorded, get ready for an informative ride. Let's start with the basics. What are equity mutual funds? Well, think of them as a pool of money collected from various investors, which is then invested primarily in stocks or equities of companies. Now, why you should consider investing in them? Firstly, they offer diversification. By investing in a mutual fund, you spread your risk across multiple stocks, reducing the impact of any single company's performance on your overall portfolio. This helps safeguard your investments against market volatility. Secondly, equity mutual funds provide professional management. You are entrusting your money to experienced fund manager who conduct in-depth research and analyzes to make informed investment decisions on your behalf. This expertise can potentially lead to higher returns. Thirdly, liquidity is a significant advantage. Unlike direct investments in stocks, you can easily buy or sell mutual fund units at their net asset value, which is called NAV, on any business day. This flexibility ensures you can access your funds whenever needed. Fourthly, affordability is a key. Even with a small investment amount, you can gain exposure to a diversified portfolio of stocks through mutual funds. This accessibility opens doors for individuals with varying financial capacities to participate in the market. And lastly, tax benefits sweetens the deal. Investments held in equity mutual funds for over a year qualify for long term capital gain tax, which is currently taxed at a favorable rate of 10% for gains exceeding rupees 1 lakh. This can significantly boost your after tax returns. But as with any investments, there are a few considerations to keep in mind. What about the disadvantages? While mutual funds offer diversification, there is still a risk of market fluctuations affecting your investments. Additionally, management fees and expenses can reduce your returns over time. Liquidity, though convenient, may come with exit load charges if you redeem your investments too soon. Furthermore, lack of control is a drawback. As an investor in mutual funds, you rely on the decisions of fund managers, which may not always align with your individual goals or risk tolerance. And finally, tax implications must be considered, especially when it comes to short term capital gain tax on investments held for less than a year. So now you might wonder, should you invest in a multi asset mutual fund schemes or diversify on your own? Well, it depends on your comfort level, expertise, and time commitment. While multi asset funds offer built in diversification across asset classes like stocks, bonds, and gold, DIY diversification allows for more personalized control over your investment mix. And speaking of taxes, let's address a common question. What are the tax implications of investing in mutual funds, especially for Indian investors? In India, the tax on mutual funds varies based on factors like the holding period and the type of fund. For equity mutual funds held for more than a year, long-term capital gain tax applies at a rate of 10% on gains which are exceeding 1 lakh. On the other hand, short-term capital gain tax is levied at your applicable income tax slab rate for investments which are held for less than a year. And what if you are considering investing in US stocks from India? Well, Be prepared for potential tax implications on capital gains, dividends, and any other income generated from your investments abroad. It is essential to understand the tax laws of both the countries and consult a tax advisor for personalized guidance. To wrap it up, equity mutual funds can be powerful tools for wealth creation, offering benefits like diversification, professional management, liquidity, affordability, and tax advantages. However, it is crucial to weigh these benefits against potential disadvantages and consider factors like asset allocation and tax implications before making investment decisions. Thank you for joining us today on our journey through the world of equity mutual funds and wealth creation. Remember, knowledge is key. So keep learning, keep investing, and may your financial goals become a reality. Until next time, happy investing. We are coming up with a session on how to double your net worth on 24th of March at 11 a.m. So the link for joining for this webinar is given in the comment box. Kindly register for it and share the link with your friends and families.